Hey everyone, today I'm talking about Dollarama stock, as the company recently reported earnings. Dollarama has been a standout on the TSX for years, and its latest quarterly results only add to its impressive track record. The company operates over 1,600 stores across Canada, offering affordable, low-priced items that have made it a popular option for consumers looking to save money amid inflation. Its ability to keep delivering strong results, even in challenging times, is what makes this stock so interesting to watch. For the third quarter, which ended on October 27th, the company posted $1.6 billion in revenue. That's a year-over-year increase of nearly 6%. But what's particularly impressive is the comparable sales growth, which came in at 3.3%. Now, why is this important? Comparable sales measure how much growth comes from stores that were open a year ago, so it's a key indicator of organic growth. In other words, it tells us that the company isn't just relying on opening new locations to boost revenue, it's actually growing within its existing stores. But it isn't all good news for Dollarama. In the previous quarter, the company's sales grew at a faster rate of more than 7%, with comparable sales growth of 4.7%. And if we look back to Q1, sales growth was even stronger at nearly 9%, with comparable sales growth of 5.6%. Clearly, the pace of growth has been slowing down in recent quarters. That could be why, despite the strong recent results, investors aren't overly thrilled and the stock isn't soaring. When you factor in Dollarama's high valuation, it's trading at over 35 times trailing earnings, it's easy to see why there might be some hesitation from investors right now. In the long run, the picture may be more promising, and that's because Dollarama has raised its growth targets. The company now plans to expand to 2,200 stores across Canada by 2034. That's up from its previous goal of 2,000 stores by 2031. This expansion is exciting because it means Dollarama is tapping into new markets and potentially reaching even more customers. But there's a challenge here because with so many stores, it has to be careful not to cannibalize sales from its existing locations. That's always a risk when a company expands rapidly, but Dollarama's track record suggests it knows how to manage its growth effectively. Interestingly, however, despite these slowing growth trends, Dollarama's stock has already had an incredible year in 2014. Since January, it's up around 50%. That's a huge gain for any stock, let alone one that's already been a top performer for years. One thing to watch out for, however, is that the stock's 20-day moving average has been falling in recent weeks. If it crosses over and falls below the 50-day moving average, that could lead to more declines for the stock in the near term. But that's a short-term problem. For long-term investors, Dollarama has proven to be a reliable growth stock, and the company's recent results only reinforce that. That said, if this trend of slowing growth continues, it may be harder for Dollarama to generate the same impressive gains in 2025 that it has delivered this year. However, the stock still looks like a solid buy for the long term. With consistent growth, strategic expansion plans, and a strong position in the market, Dollarama is well prepared for the future, but the pace of that growth may determine just how bright the future looks and how high the stock can go. If you're looking for a good stock to put in your tax-free savings account, Dollarama could make for a good option to buy and hold for the long term.